Hey everybody, welcome to Trading Capital's Daily Analysis video. I'm your head market analyst here, Curtis Gowden. Jumping into the charts on this December 13th. What a wild session. Today was the long-awaited CPI. Headline number came in lower than expected. So obviously what transpired was the markets love that low CPI number. And when I say low, this is what makes it so funny is you have these rip-roaring rallies. I think the S&P was up over 2.5% at the highs. The Nasdaq was up over 3%. So when I say it came in lower than expectations, 7.1% headline number on the CPI, that is still so much higher than the 2% target that we're supposed to be trading around. And when you analyze the important aspects of why the CPI is coming down, it's mainly attributing to used cars and energy prices. And when you factor in at how significant the declines in both the energy and used car market have been, obviously you would expect that inflation would come lower. But when you factor in that food did not decline, it was up by 0.3%, and as well as rent and wages are still not declining, that just shows you that inflation is going to be sticky. So there's going to be a point in these CPI reports where if we don't see a decline in rent inflation or food, inflation is not going to come down, and we may have these reports where it actually surprises the market. So with the drastic decline in energy prices, obviously everyone is thankful for that and appreciating that, but we also have to keep in mind, is it really a true decline in energy prices, or is just the Biden administration been suppressing the price of oil with $1 million barrel release from the SPR? Obviously that plays into fact. I still think the interest rates that we've hiked over the last 12 months have to really hit the real economy, and we will see that likely in the new year. But looking at the daily chart, once again, nothing's changed in my perspective. In fact, since we've got a nasty reversal candle on volume, it just signifies to me that these two major little double top zone is going to be a very tough area to beat. And if we could not get it on a strong CPI reading, or at least a number that the markets expect, then how are we going to get through this? Do we really think Powell is going to blast us through this with his commentary? Keep in mind, this was a big sell-off where Powell basically caused this red bar reversal over here. Now we're trading into that area, and once again we're waiting on Powell, the big FOMC interest rate decision. Now, in terms of what, let me just discuss this S&P before we go into yields. But if we look at what transpired today, we had a massive gap up on that CPI reading, and then the markets just got faded. You would have expected to close at least above this or above this green strong bar, but you failed to close and you reversed, and it's on heavy volume, over 104 million shares. So that is short-term not good for the bulls. And if we simply look at the intraday action, it was really just a big gap up and then a fade right from the market open. The sellers just started commencing. Now, when you have momentum, and in order to cause a deep sell-off like this, right when the volume is highest at the open, that shows that big money is offloading. That's institutional sellers dumping into the hype and the rally of the smaller retail that are buying this market up. So the fact that we could not, basically the gains were in the pre-market, whereas retail wasn't trading, and then all of a sudden the dump started occurring when in bigger retail, or when smaller retail investors did start trading, as well as the larger influx of volume started to commence. So that's just interesting price action. This short term is an inside bar bearish consolidation. And again, the fact that you're still extended on the chart, you've had a nasty reversal, you're still elevated in comparison to where I think Powell wants these markets. I do think that there's more downside in this markets. Now, in terms of how far, I think the first big downside level is we're going to test this pivot low down here. Maybe it's not a straight shot down there tomorrow, but it's certainly we could make our way down there quickly depending on Powell's tone. Now, the market is expecting Powell to raise rates by 0.5%, and that's certainly what is priced in, I believe, at the moment. But you can see that currently we're at 3.75% on the Fed fund rate, and the US 2-year is at 4.23. So with a 0.5% hike, that matches up with the 2-year yield, puts us slightly a little bit positive. Now the 2-year yield has never been lower than the Fed fund rate, so that is just a very interesting phenomenon. Typically we've never seen the Fed hike past this 2-year yield. So that is going to be really interesting to where this goes from here. Once we get that rate hike tomorrow, if it is 0.5, then it's in line with this 2-year yield. and that means that the Fed may start to back off unless the bond market really dictates the flow of money otherwise. But again, we still have this topping formation in effect. It was teetering on this neckline. The fact that you have not closed below this wick low basically means that we have not confirmed a breakdown. But you do have potentially this bigger topping formation in play. So I'm going to be looking for a close below this yellow line. Now let me just make that bolder instead of this red one. So a close below this yellow line will signify that we've likely reached the peak in interest rate cycles, and that's when the economy will start to deteriorate at a faster rate. But let's just really take observant of Powell's tone tomorrow around 1:30 or 2 o'clock, because that's going to dictate where the bond market starts to reprice assets. And I still think that even if Powell is less hawkish, that is probably meaning that he's interpreting data that generally means that the economy is weakening a lot faster. Because from my perspective, when Powell in the last meeting was uber hawkish and then he was not so hawkish, he's flip-flopping around as if there's a lot of conflicting data, and I think there is a lot of conflicting data. Let's take a look at the dollar. I still in the camp the dollar has to get a little bit of a pop. You've still seen a sharp sell-off. If we flip to the weekly chart, the dollar is into big time support. You have this basically this top over here, a little bit of a wick support a little bit lower, and then even if you get a flush lower, you'll have a massive support trend line. You're at the 382 fib level here, so it's a big level for the dollar. I believe that we should see at least a little bit of a test back up maybe to this 200 if Powell is a little bit more hawkish. So that's going to be the big level. If we can recapture this neckline for the dollar, I do believe the markets will be in for a furious ride to the downside. But that's kind of the expectations. Even if we don't recapture that, if we look at previous cycles, the markets love a falling dollar up until a certain point. And right now, this is still the critical inflection point. 104 is about that special critical tightening point where it is still considered a weapon used for tightening against emerging markets. So do I think the Fed is done yet? Do I think they're not going to try to export more of the inflation outwards? I think they're probably still going to export a little bit of that inflation outwards just to relieve some of the pressure off American citizens. But time will tell. We'll have to really see what Powell says. It's all speculation up until this point. But in terms of the risk-reward setup, I still think the markets have more downside. If we look at the S&P or the semiconductors, the SMH really intriguing because once again you've popped up and gapped up above that 200. Notice how you've had a gap here, failed reversal. You had a massive impulse move above trying to get that 200, and then you've reversed lower, and now you've had another gap over that 200, and you failed to confirm above basically these highs over here. So what that tells me is we're likely to see semis come back down to the low end of the range, if not more. And again, if you look at the big breakdown level where the price action is being kept intact, this red trend line is your key area because it was your little bit of a left shoulder, your big double M top pattern here. You broke down, had a bounce, broke, confirmed down, retraced over here, and then you fell and made new lows. So the fact that you're teetering above this line, but now you failed to confirm above it for a few weeks here, just leads me to think that if we can't get above this, the bulls are going to run out of steam very quickly. And from my perspective, this type of reversal in the semis into this wide range red bar, it does look like there's big sellers stepping into effect. Just like we had a big influx of volume on this today, if you match up this candle here to this red bar sell-off, it's on similar volume. And that was really the big breakdown point that sent NVIDIA making much steeper lows. So again, noticing the volume trends are very similar to the original area we broke down. I observe things of that nature because it's important correlations. Typically, in this period here, you have an immense pressure of sellers sitting. Arguably, the same sellers that sold here are also selling here. Funds will hold on to positions and they can't really sell their whole position all at once. But if that pattern somehow retraces all the way back up to that key level, they will look to offload more of their positions. And that's kind of what is transpiring here. Now, it'll be interesting to see if we get more follow through. Now let's keep in mind that rising stocks and assets have a direct impact on inflation, and Powell knows this. He used to be a fund manager, so he's very, very aware of how all of these institutional options market work, stocks shorting, but the whole 9 yards. But the one thing we have to keep in mind is his objective is to tame inflation while obviously keeping financial stability. But in terms of the S&P trading all the way up to these lofty valuations, yet again, I still think that there's more downside. And let's keep in mind the big level 2 that we're teetering with on the S&P, and charts are just so wild because if you take the COVID low to where your original breakdown point happened, basically you have not confirmed above this COVID trend line for now since starting in early November. We've just been teetering and teetering and teetering. And if you take a look at the wedge formation which we were trading in, and you can see that was the formation that we watched. We broke, we never confirmed. Now we're back, we pierced above that wedge formation, but we've actually now closed back below. So the big question is, will we get a secondary close outside of that wedge tomorrow? If we do, then the probabilities severely swing for a move to this 373. So if we get a closing low tomorrow lower than what we closed today, this wick low over here, that will be an extremely bearish sign in my opinion for the markets, and that's certainly what the technicals will, well, we don't know what the technicals are going to show us yet, but if the technicals show us a secondary close below this wick low, that's going to be a very, very likely bearish scenario for the markets. If we take a look at gold, gold also saw a pop right into resistance. I have basically this double top zone over here, which we tagged over here on this wide range red bar, and you basically also you have this beautiful symmetrical channel connecting a pivot to a pivot to a pivot, and look where you tagged to a T. Now, could gold go a tiny bit higher? There might be that scenario if gold was to retrace to this previous trend line connecting pivot low to pivot low. This was basically your topping formation on gold, which triggered, you got your retrace, breakdown again, so you could potentially go up to around 1830, 1835, but again, in terms of gold being at resistance, it is at major resistance, and I would still likely favor a move back down to the 1720 area to potentially look to load up on a swing long. Oil's interesting. Oil got a nice pop today, up over 2.84%. It was up over 3% at the highs. Notice the price action in oil basically peaking and piercing through this yellow trend line, your key trend line of resistance which we're watching. This trend line was support, now it's resistance, so it has peaked above that level, but it pulled back off and started to close back below that trend line. So in terms of oil being bearish, I'm still bearish on oil for the simple fact that we're going to see more economic demand unfold, especially as the real estate market starts to slow down. But as long as oil stays under this trend line, I do believe that we're going to hit 68 to 66 pretty soon here. Maybe even in the next 1 to 2 weeks we could hit that. But that's relying on the fact that as long as we stay closed below this yellow trend line. If we peak up above this yellow trend line, then my thesis changes. We can basically go all the way back up to about 83, and then we'll have to reassess from there. But in terms of for now, I still see more negative price action in oil. Let me just take a look at natural gas. Obviously, we are along the KOLD, so we could have taken profits yesterday on natural gas, but nonetheless, natural gas actually did pretty much have a nice pop today as well, up over 6.5%, but you're still stuck under resistance. Basically, that short level where we shorted yesterday, you're still at. Now, in terms of natural gas, I wouldn't actually mind if it goes a bit higher. I do think the overall outlook for natural gas is grim. Basically, a big retrace level would be this red trend line going all the way up, connecting your pivots over here, your pivot breakdown point over here, another pivot, your chop. If you can get a retrace up to this 755, I will look to accumulate a very, very large position. Now, I'm not saying it's going to get there, but that will be the next short level to add at. If you get through that, then you will have another secondary level over here, which you could even play if you got through a retrace back to the original head and shoulders neckline. Basically, this is the first topping formation in your cycle high top that you put in. So there's about 2 more additional short levels where I'll look to accumulate some pretty heavy positions on natural gas short. But until we hit that, level. We're just going to have to continue to wait and see. Looking at the QQQ, basically the QQQ retraced again to this neckline. This is your head and shoulders neckline. Sorry, that's not your head and shoulders neckline, but it is a key breakdown point in your little bit of a topping formation here. So you can see you've hit it once, you've hit it twice, you've hit it 3 times and had a massive reversal on volume. So what that's telling me is you've typically, when you challenge a level 3 times, 1, 2, usually on the 3rd time you break through. If you fail on the 3rd time and you confirm it on volume, the probabilities dictate that you're going to see much lower price action. And basically off of a reversal of this magnitude, that's certainly what the charts are pointing to. Now, is there still a major gap fill up here? Yes, there is. Have you tagged the 200-day moving average? No, you have not. The S&P has. So maybe there's a slim hope if Powell doesn't crush the markets. I think really Powell is going to be the new directional trend tomorrow. He's going to either make or break the trend. I think the big term trend is still lower, but whether or not we get a few more days of upside is going to hinge on Powell. Maybe the Qs, if we do get some upside, can hit the 200, but that's a big if. To get through this wide range red bar on volume is going to be very, very tough. Even though the markets did finish positive today, I don't really view this type of reversal as a positive, because when you look at the candle size, yes, you're up 1%, but you gave back about 2%. So that just shows you that there were a lot more sellers lurking as soon as you hit these massive, massive technical levels. Really, that sums it up for today's video. Please give this video a big like down below. We did add to our NVIDIA short. Obviously, we are accumulating. Oh, sorry, that's the wrong chart. I don't even know what that chart is. Vonda. That's not a healthy chart. But NVDA. I got excited there. I thought NVIDIA dropped. It would have had all my alerts. But you can see we added to NVIDIA pretty much at the peak high. One of the reasons I added, massive technical gap fill from that August breakdown. And you can see that's pretty much had a nasty reversal on volume again. In terms of NVIDIA being extended, I mean, when you factor in NVIDIA was just trading at 108, now it's all the way up to 80. That's almost a 70% move on NVIDIA, and that's certainly nothing to sneeze at. But again, I think that you've had a meaningful retrace on NVIDIA, a substantial move off the lows, and I do think we're going to at least come back to the low end of this range, or potentially even back to this original breakout point. You know, this 144 level is a big bounce level, in my opinion, for NVIDIA. That's going to be the big tell level. If you get a big significant bounce off that level, whether you hold that bounce or not, but I do think that we see a retrace back down in NVIDIA as the markets trend lower. But please give this video a big like down below, and we'll see you on the charts tomorrow. And congratulations on the profits that we did pull. We banked a beautiful winner. Let me just pull up GRND. So Grinder, we sold today on that pop. Beautiful pop, because look at that. It popped and then we sold. So that was a beautiful over 14% job on that trade. So amazing, amazing job. Well done on that trade. I believe there was another couple other things that we did. We also sold our Zoom. So Zoom was an amazing, amazing trade. Look at that beautiful sell alert, 77.33. And look at that reversal, basically closing just slightly positive on the day, but it did dip into negative territory. So the fact that we were able to get out on that beautiful pop just shows you what reading the intraday technicals can do for you. But take care, everybody, and we'll see you on the